rent and sales comps. These are all very important. Anyway, just providing some data though is great. So I think you've done a good job. You can tell you've done this by hand. And for me, that carries a lot of weight for me, because if I know that for you to go out by hand and get this data versus for somebody just to pull a report on Yardi or wherever and get those rent comps, means that you did a lot of research here. That's what that tells me. That you've done a lot of research. You feel very comfortable with these numbers. And so I think as a passive, just keep that in mind, that you can kind of tell if somebody had to really work to get these numbers, that they've done a lot of research, that it's not just them running a report online and selectively choosing.
Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Four Oaks Capital. I'm very excited for today's show. I know I say that every time, but I really am super excited for today's show. This is a throwback episode, episode 19. We had Joseph Bramante and Heshel Mangel on the show, and we have both these gentlemen back on the show today. Incidentally, that was the top episode for about a 6-month period. It's still a top 10 episode. So if you have a chance, go back, check it out, episode 19. And that said, gentlemen, welcome to the show again.
Hey, Brian, good to be here.
Thank you, Brian. Thanks for having us back.
Yeah, absolutely. So let's do this. Let's do a little update since we've had both of you guys on the show. And one thing I forgot to mention, we did have Heshel on the show again for a first deal episode a couple months ago. That episode will also be pretty close to the top when this releases as well. But Joseph, why don't you tell us what you've been up to since the last episode?
Yeah, sure. So since the last episode, we've acquired 3 properties, about 500 units, and we have gotten entitlements done, permitting done on one of our new developments, the 400 unit property we're breaking ground on. And we have also just finished completing preliminary design for another new development, mid-rise here in Houston. So we've really been leaning into the new development space things. Also just finished wrapping up the final edits on our own podcast, the Engineering Passive Income Show. So excited to get that launched later this month. It's going to be focused really on the engineering audience, because I'm an engineer and we're a special bunch of people. And so I really just wanted to bring passive investing in discussion with the context of the engineering mindset. And then also we are launching, it's getting finalized now. We're hoping to be launched this month, but maybe next month, but it's the Passive Investing Academy. We've done some beta testing with it. All the content's already created, and it's basically we go from top to bottom, and we teach passive investors how to break down investment packages from their perspective. So it's not, most of what's taught is how to buy a property and how to break down a deal, or how to invest in a deal from an active investors. Like if you have all the data, you have these complex models, but nobody's really addressing it from the passive investor's perspective. Whenever they're given that PDF package, like we're going to be reviewing today, like what do you do with it? Yep. And so that's the whole course is about that. We've had some amazing testimonials for it. So we're just happy to get that launched.
I think that's an amazing product. Now I'm gonna back up a little bit. You talked about closing 3 and moving into development. Can you explain why you're going from buying existing to development?
Yeah, I mean, anybody who's tried to buy a deal in the last year has realized cap rates are getting very tight, and your margins are getting squeezed, and it's getting very difficult to make these deals work if you don't with the same cost of capital that we all have access to in majority. So we made the decision, saw this coming 4 years ago. So this isn't a new thing. We've been in the new development space learning since 2016, and it's taken that long. I've done this the long way. I could have, about 2 years ago, I finally partnered up with somebody and we've accelerated our growth. And I think that's true with anything. You can do it by yourself and you can spend a lot of time doing it, or you can partner with somebody, you can go a whole lot faster, and especially when it comes to new development, because it is extremely complex. And with acquisitions, it's pretty worn path. You do this, here's your steps, and you get from point A to point Z. With new development, there is no kind of step one, step two, step three. It's a very iterative process. You go to step four, depending on the results of step four, you go back to step one. So it's very complicated. So anyway, that's why we went into new development, because we have seen the flight to quality. We've seen the compression of cap rates, and we really are investing more for the long term. We want to have these nice, beautiful assets. And there's much bigger returns for our investors whenever they're buying, whenever they're building something. Their basis is so much lower versus when they're buying it.
Yeah, absolutely. Now, if you look at return profile and risk, can you talk a little bit about the difference between buying an existing A, B, or C class versus, a new development? What's a return profile look like versus the corresponding risk?
Yeah. So on a new deal, your risk, if you're buying value add, your risk would just be, did the syndicator underwrite it correctly? Do you get the rent bumps that were projected? Were the expenses and taxes as projected? And I think your margin of error, I would say, is probably a little bit less, because if your chances of losing money are much, much less. I mean, at worst case, you don't make as much money as you thought on acquisitions versus on new development. Your risk profile there is you're not dealing with, the loans are all full recourse. So, versus acquisition is majority non-recourse. From the building perspective, your costs up front, you do have some upfront costs. You got to acquire the land, you got to spend money on engineers and architects to get it built. But the big money isn't really spent until the loan is secured. And at that point, then you're spending millions of dollars. So I'd say your upfront cost is about the same until you go to break ground. And then once you go to break ground, there is some risk that the risk of it not getting completed is very minimal. You're going to build it because the projects are bonded. Also, by the time you get to the point where you're breaking ground, the lenders have vetted this like you wouldn't believe. It's been through so many checks and balances to make sure that the project is viable, because the bank is your biggest investor on this deal. So they're not going to build something that they don't think would work. And then when you get to the point of stabilizing it, now you get to that risk of you build it, will they come? And so if you're in good markets, like Houston market, major markets, it's less of an issue as when you try to build in more tertiary markets. It gets to be, with lower populations, that gets to be somewhat of an issue. So you got to put checks and balances around all of those. But I think people, when they see development, they're more worried about that latter half of, okay, I built this, that lease up period. That's where you kind of make your money there, is if it takes forever to lease up or not. But the windfall on the back end, though, I mean, your basis is much lower. And once you've built it, you've stabilized it, typically you can exit it within 3 years and you get this huge windfall profit. So I think that the risk reward is in check there. So higher risk, but higher reward.
Okay. All right. Yeah. Sounds everything on par with what I've heard on that stuff before. The new development area intrigues me. One of these days, we may jump into that as well, but I think you're absolutely right. With where cap rates and competition have gone, it's extremely difficult to find deals in the marketplace right now. So
the other quick thing I'll say is the time component is completely different as well. I've been, working on one deal for 4 years already. And so if you're somebody who's trying to go quickly on a deal, acquisitions all day long, you can grow a much bigger portfolio acquisitions than you will do development. So we just kind of branched off into new development while still doing acquisitions, so we can do them both in tandem.
Okay. So longer time. Got it. So perfect. Well, thanks for the explanation. Very much appreciate it. And, glad you're doing well, and, shift gears really quickly. And, Heshel, how you doing, man?
Awesome. Doing very well. Good to be back with you guys, with both of you.
All right. So we last had you on, I think, about 3-4 months ago on your first deal episode. And actually, it wasn't your first deal. You just showcased a deal that you had recently closed. Tell us what's new.
Yeah. So at that time, we were showcasing a deal that we had recently closed. And I think as well had touched on a deal that we were in the due diligence period of, that we were getting ready to close on, and we did successfully close on that about a month later. Since then, we've definitely felt the constraints of the market. It's definitely been a a slower to come to find good and viable deals that are making sense for us and for our partners. At this point, we are getting ready to close another property here in a couple weeks and have another one under contract that will probably close in about a month and a half or so. But we've definitely felt the pinch here in the market, and then eagerly walking through this and through the times and just adjusting with the times and learning as much as we can throughout the process, and continuing to stay in touch with people and building our network, and we'll come out of this stronger.
All right. Sounds awesome. Now, are these new acquisitions all in Ohio still, or are you branched out a little further?
These are in Ohio.
Okay.
Both of these are in Ohio. Yes.
Okay. All right. And I think the one we showcased last time was a Cincinnati property, right? 32 units in Cincinnati.
Right.
Okay. Sounds awesome. Well, let's jump into, the deal review, and we're going to have some slides on this one. So we'll do our best to explain it for those who are listening to the podcast. We're also going to drop a link in the show notes to our YouTube page, so that you guys can go to YouTube and watch this with the slides. So that said, I'll let you guys take it away.
Great. Well, before we get going, I just want to be clear on what this is and what this is not. So this is not a gotcha kind of presentation at all. And I just want to really commend Heshel for even doing this. I mean, he's putting his deal out for all to see and let me go through it and provide some very careful minor tweaks and updates, but still just have anybody go through your deal. Really, to me, just shows to me that Heshel's commitment to constantly improving and getting better. And if I were an investor of Heshel's, I would be honored, because I mean that's what you want to see. You want to see people pushing themselves, trying to get better any way they can. And this is how you get better. And now he's, basically by putting this out here, a lot of people are gonna get better as well. Because I know for a fact, because of that course that we have, Passive Investing Academy, I know for a fact people are making a lot of these similar type things. And so by going through this, hopefully others will see and we can all improve together. So thank you, Heshel, for agreeing to do this.
If I can add my 2 cents on the first episode, the Ask the Expert episode, if I remember the number right, Heshel, you had about 55 units already under your belt. And I had asked you to come on as an expert, and you just turned it out on me and said, hey, I want to learn more. Can you please pair me up with somebody? And I was actually quite impressed with that as well. And I echo exactly what Joseph said, Heshel. I think that's an amazing quality in a person. You're humble, you're teachable. You're also just an amazing person. So thank you for being you, essentially.
Oh, thank you. I appreciate it. We're all working to help each other out and continue to grow the industry. So I appreciate both of you.
I should also say that I'm trying to emulate you guys with the great facial hair, but
yeah, I like it.
We're getting there. Yeah.
I like it.
All right. So I've shared my screen. I believe you guys can see it now.
Yep. We got it.
All right. So Heshel, I believe this was a 3-pack deal you were doing, Columbus 33. And this is a very minor thing, but a lot of times people are printing these like me. And so whenever you print them and you have a colored background on all your slides, and it uses up a ton of ink, it just sometimes can, I would just, as a formatting point, I would recommend avoiding colored backgrounds for an event that people do print them. But again, that's nothing to do with the actual deal itself, just the formatting. So we've got, on slide 2 here, a table of contents, your standard kind of disclaimer, perfect to have all that. Then we're in an executive summary. I think this slide right here, the intent of an executive summary is if the investor reads only one slide, this is it. They can throw the rest of the package away. In my opinion, this is the one slide. And then if this slide is good and they want more detail, then they can read through it. But if they don't, if they the objective on this slide, right, done well, is that they don't need to go to see the next slide, because everything they know about the deal, at least at high level points, is there. Now, of course, some people are really big into the details, and so they're going to dig into it. But you've also got that other set of the population that's not big into the details, and they just want to know, give me the high points here, and then they'll make a decision for that. So I think you did This executive summary for me felt a little wordy because you've got to actually read through some of this. And, on ours, we try to keep it more bullet points, shorter sentences. There's an entire paragraph here on the left side of the page. So just something to keep in for note. And I'm just going to point out on the right side here, kind of broken out your investment snapshot, showing your sources and uses, which is basically what that is on the top right. Now, looking at that is by somebody seeing the sources and uses on the top right, is that a decision-making criteria for them? I would argue maybe it's not, because it's good to show the sources and uses, which you do later on in the package, but somebody isn't going to make a decision. And so you've used up about 25% of your slide right here, showing the sources and uses for somebody, which isn't really going to move the needle for them, other than to see really the main point, which I believe you're trying to drive here, is that you're raising $650,000 for this deal. So I would have possibly just condensed it to total equity need $650. And you do show some of your purchase caps, your key metrics here. So you showed a purchase cap, which is 9.5, which is unbelievable, by the way. I would love to have a 9.5 cap deal. It reminds me of back when I started. I was started back when there were 12 caps. And now it's just like a distant memory. But
I'd say at this time, I'd love to have a 6 cap. So, I mean,
oh yeah.
Wow.
So, but keep in mind, how many units are we talking about here? This is, how many units was it, Heshel?
33.
33, of course, 33. So I think on smaller deals, I believe, again, I don't know, I'm not really in that space. I don't know what cap rates are on smaller deals, but this might be in line with those deals. Could be wrong. And also, just keep in mind, though, another thing I want to point out is that the way you're going to present a deal of this size, I'm not being critical of the size of the deal at all. I'm just saying that when you're presenting a 250 unit deal versus when you're presenting a 33 unit deal, you're not going to have as much, you're not going to present it the same, you're going to go into the same level of detail, I wouldn't imagine, because it's a smaller kind of, I don't mean this in an insulting way, but simpler kind of product that you're presenting here. So back to key metrics. So we're showing cap rate, we're showing average annual return, we're showing hold time. One of the things that's missing here is the IRR. I don't see where that's shown. That's a big one. A lot of times, so IRR is this universal metric that people will use to compare across deals. Like I can put my money in deal A or deal B, and this is the IRR return. And it factors in everything from the amount of investment to the hold period, to the distributions, to the exit price. And so putting in an IRR for your investors is very useful. I know in this day, a lot of people would try to put ranges on their IRRs. It could be between 16 and 17%. And our personal preference of mine is really just to draw a line in the sand and say, we're going to hold this for this period of time. And these are our assumptions. And this is what the number we're projecting. And then if you want to give a range, then you could say it's going to be, say, a 16% IRR plus or minus 1%, if you wanted to give a range. But I think it's important that you draw a line in the sand. You say, this is our number. So anyway, IRR, we're going to hold this for 7 years, for refinance in year 4. So that was all the executive summary. Now we're going to go on to the next page here, which is our property overview. Again,
and Joseph, just to recap a little bit on that last slide, what are the key pieces of information that need to go on that executive summary? We talked about, IRR needing to go on there. We talked about purchase price. What would you say are the key pieces of information that absolutely need to be on there?
Yeah, so you're going to want your equity being raised, your IRR, your purchase price, your hold period. You're going to know if you're spending rehab. So you do mention your capital improvements up here. So if you're doing a rehab, you should definitely mention, hey, we're going to spend $200,000 doing a renovation. Your rent bump, because that's a big important thing to say, hey, we're going to do all this, and our rent increase, our average rent increase is going to be this. Average occupancy or average vacancy on the deal is another important one. And then it can get also you want to see what are your terms. So we're going to be, this is your preferred return on the deal. This is your promote. Sometimes if you have like a dual class structure or some crazy waterfall, you want to list all that out as well, just to give the investor everything they need to get on that one page. And that's why you kind of have to do it in bullet points. it's a bit of an art to get them right, because you don't want to be just too busy. It's an exercise in simplicity, if you will, just keeping it nice and clean, enough white space on the page. It's a combination of art and math, if you will.
Perfect. All right. Thank you. Thank you very much.
So now we've gone over to slide 4. Any comments on that, Heshel? Do you resonate with that, or?
Yeah, I mean, that was all very good points. And as you're speaking, and I'm writing these notes down as well. I think it's just clarifying in my own head the purpose of each page, and really treat each page as its own piece of real estate. And as you as a developer knows very well, that it's about maximizing the space that we have. So you really want to know the goal and the purpose of each page, and bring out the point.
Yeah. And by no means one of these PowerPoint experts. I know there are people that go out and they do this. My background, so I worked for Exxon for 5 years, and they're very big on nice, clean formatting and also perfect numbers. So we had to kind of get both, but I've seen some beautiful packages out there. I mean, there's a lot of people that outsource this stuff, and they do a really good job. But for those of you who aren't outsourcing, I don't outsource it as of yet, and we do just fine. So those are just some tips for you. Property overview. So I think, yeah, this is important as well. You've kind of covered the basics. You've got a little description on the left side. Talk about, here's your number of units, your unit mix, when it's built, current NOI, then you put the utilities. The question I would say is this really a page 4 slide, or is this one that should be further in the back? Like, you just hit them with the executive summary, and then now you're saying this is the deal. I'm not saying it's wrong. I'm just saying maybe you could look at moving some of this further back in the package.
So do you think more of the numbers associated with the deal that we just really spoke about under executive summary, that stuff should come earlier?
You're going to pull the executive summary is going to have, you're going to say, hey, this is a 33 unit property that was built in 1969. You're going to cover that already. I think those are the 2 big bullets on this slide. So now that you've already addressed it on your executive summary, this then becomes a detail page that you can put further back in the package.
Right.
So now we're on to the business plan. I think this is very important to have kind of what is the plan. So here we're saying you kind of list out business plan, big paragraph across the top. What is your general plan to do with the property? It sounds like you're going to bring professional management to the asset and improve the operations of the asset. So I'm assuming this was probably like a mom and pop style deal, and you're taking over, you're going to bring some professional management. Perfect.
Right. Yeah, exactly.
And so then you kind of list your, I like when you 1, 2, and 3, it's great. So your 3 bullet points. And so step 1, you're going to upgrade management. So you're going to bring your own systems and processes. That's great. Step 2, you're going to improve the value by investing in the unit turns, spending some money, basically doing a value add. And in step 3, you get this long-term vision where you're going to capture stable cash flowing asset in a time of market uncertainty. And so here, I guess you're talking about using debt and equity and whatnot. And yeah, and then you're kind of playing on the longer term, just real estate as a whole, it sounds like.
Right.
Now, Joseph, you mentioned the slide on the property summary should be a detail slide later. Is this business plan what you'd like to see right after the executive summary?
I think so. So I would, a couple of things. One, it depends on who the time of the meeting and the presentation itself. So like on a deal that we closed in October, I actually had 2 presentations. I had one that was a 20-minute presentation that I borrowed from Orion Kaf, or Kaf.
Mm-hmm.
He's a famous, you can Google him. He does a lot of pitch decks and whatnot. And I borrowed his format for that. He's specialized in that very quick upfront, get him in the door. And then I had another more detailed presentation where it's like, hey, if you like that one and you want to learn more, or if you want to invest, great, let's invest. But if you want another presentation that's more detailed, then I had a more detailed one. So one, it kind of depends on which presentation is intended to be. Is this supposed to be an end all be all? And then if it is, then I would want to see the rest of the slides to determine, and then kind of make that judgment. And so once you've kind of created all your slides, then you kind of look at everything and you should always ask yourself, is this the most important slide for this point in the presentation? And figure it out from there. So I think generally having this business plan towards the front is good. It's definitely not a back half slide. It's definitely a front half. Now, should it be number 5 or number 6 or number 7? That's to be determined with the rest of these slides.
Okay, perfect.
So then we get into the financial summary. So here you're repeating your snapshot. So again, you see how we talk about that executive summary. So you're already showing the detail here on what that, on the top left, you kind of break out the source and uses again. And then you show your closing costs on here. So you've closed a couple deals now. And so what I would challenge you to do is to go back on the deals that you've closed, break out those closing statements and look at what your true closing cost was, especially because I believe you're closing deals mostly in the same market. So your title fees, et cetera, would be pretty consistent. So for us, all of this is about this one line right here. So your closing cost detail, you break out lender cost of 20,000, due diligence cost of 10,000, closing, reporting, and legal of 40, and acquisition fee of 30. So I think it's for this slide, when we're presenting to investors, I think it's good to have it, grouped like that. But on a Excel file, you should have it broken out in more detail. I don't know if that's the case or not. Maybe it is, and maybe it just happens that they all end up perfectly 20,000, 10,000, 4,000. Most likely not, but if that's the case, great. But the challenge for you is to break out those old closing statements. And what we did, so every deal we've closed, we used a closing statement and we figured out where we missed at, because there's nothing worse than going to the closing statement or going to the closing table and you're short a couple $100,000 because you underestimated something or something came in more expensive than you thought, et cetera. I've been there, I've done that. It really sucks. It's a lot of stress. We just closed a $36 million deal in October, and we were over by $100,000 on our closing statement, which was great. So, but the way we've gotten it really accurate is, one, I've interviewed and I've sat down with our title company. I said, hey, how are you calculating all these costs? I've noticed that a T19 endorsement shows up on every one of my deals. What is that? What are my reoccurring title costs? And we've programmed that into our pro forma, and we've figured out how to, put some logic behind it. And you have all the data that you need to calculate exactly what the title cost is in your pro forma. So I would, it's a little bit of an advanced step, but I know you can do it. So I would encourage you to reach out to your title company, reach out to your attorneys. If you've got an attorney you're using every time, say, hey, what can my range of legal costs be? And yeah, just kind of see where you're at. Just for reference, our sources and uses page on our pro forma is about 60 lines. So it's rather detailed, and we break out every single thing. And then of course we condense it for the presentation to the investors, but the investors also get a PDF copy of the pro forma and they can see every single line. So that's a challenge for you that will help you definitely in the long run. In the short term, you might not see as much value from it, but as the closing amounts get bigger and bigger, the margin for error is much more meaningful. So there's that. And then so on that right half of the page, you've got your operating summary. I'm assuming, are you trying to say this is your trailing 12? Is this the current state of the finances?
This is the current, this is where we will be currently, like if we're taking over the operation, putting in our management. So it's the current rents with our management.
Okay. Yeah, it just would have been, I would have liked to see it. It just was a little confusing. That's all. Maybe consider making it a little bit more clear that this is the, the trailing 12, the current in place financials for the property.
In terms of detail, how do you suggest walking that where you can't make a financial summary 60 lines long and give every detail, and frankly most people probably are not going to be interested in seeing every single detail of the deal. They want to know, okay, how much is this going to cost us, basically. So
so I'm not saying you give, so that's not in your presentation to the investors. So that's, we've got just like you will, you've got your own pro forma in Excel that most investors won't care about. Some will, and I'm sure you'll give them either a PDF copy of it, or if you want the Excel version, however you are, but and you will take that and you're going to condense it like you did here. So you've condensed it from your Excel version. for the presentation. So we do the same thing. We bucket it all together. So there's only like 3 lines or 4 lines, but the detail is there.
Yeah.
And whenever we
So it's
bucket it
accurate.
together, it's, it's $21,250.10. We're not, it's very clear that these are all calculated numbers.
Right. Understood.
So that's all you're right in that you're going to group all these, but somewhere you should have that detail.
Right. So the numbers will be accurate, not rounded numbers.
Gotcha. Okay. So that was the financial summary slide. We're on page 6. That is great. Now we get into the rent roll. This is one where, so this is one that you can only do if it's 33 units. So you wouldn't have done this. You listed all 33 units of a rent roll on this slide. You probably could have done this in 2 lines. I see a 1-bedroom and a 3-bedroom. So that could have been your 2 lines and that would have been it. So this was kind of a waste of space in my opinion. Because I would have, again, it's the formatting thing, but I would have put your market rents, I would have put a total at the bottom of market rent, a total at the bottom of rent. Instead, because you put all 33 units on your page, you had to kick it off on the side to what the totals were. So anyway, just stuff that, you can, that's one of the differentiating factors on a 250 unit deal versus a 33. So you're not going to see 250 units listed on a PowerPoint page. But yeah, I think once you condense this down, that honestly, that could have gone maybe on your property page, your property overview page. You could have listed that there. And if you want after this, I'll send you one of our deals we did. You can use what you want and see how we've laid it out. Choose what you will. So now we are on slide 8, where we're looking at the returns for the deal. So you've listed. So you got kind of ownership structure. I thought this was pretty neat. You say the left half of the page, you reference the paragraph is to be read with the operating agreement. Investors will receive 75%, and manager will receive 25% of all cash flows. Cash is to be dispersed quarterly. Upon refinance, you'll be paid back first, then remaining split. So that was a whole lot of words just to say that it's the 75-25 split over whatever pref. Like you could have been, that whole paragraph could have been 1 sentence. Investors are short for time, so you have to be quick, concise, especially on a presentation. Presentations should not have complete sentences because you should be presenting this. I mean, I imagine you're either going to be presenting this in a webinar or you'll be presenting it one-on-one, but the intent should not be that they're reading this. So I would condense that. Then now we're on the right side of the page. You've got a box here, the top left and the top right. So you list out the deal returns and the investor returns. So you list out the ROI, average cash, and IRR for both the deal and the investor. So my question is, why are you showing the deal returns? What is your thought behind showing the deal return?
The thought was, as we wrote out our pro forma, so we come to, how much cash flow there basically is and what the returns are. I wanted to share that with them. Even, ultimately investors don't receive the entire, the entire free cash flow. It was just showing them the final product that we came to through our underwriting.
You were showing it in an attempt for
transparency,
which I think there's a better way to show that. Because basically what you're showing is you're kind of showing the net of your fees. This is how much you make as the investor. So
Right.
you want to be transparent and show them, hey, this is how much money I'm making, which I think is fantastic. We do the same. I encourage all syndicators and actives to show, full disclosure. This is how much money we're making. And I think as a passive investor, you should want to see that somewhere. And when you don't see that, I think it's, I just don't like it. I would be a little concerned. You should always be transparent because they're transparent about how much money you're going to make, right? You see right here, 100,000 investors, you're going to make this much money. So I think it's only fair that people see how much the sponsor makes as well. But the reality is, though, nobody makes this deal return, not you as the active or the investor. The deal return is what the property makes, but you actually make much more than that because you don't know what your basis is in the deal. If you invested no money into the deal, then your IRR is infinite.
Yeah.
So it's really, again, kind of a wasted spot there.
Now, I'm going to ask one more question for you, Heshel. I think on the earlier slide, you said refinance year 4, and it was going to be a 7-year hold. You've got years 1 through 5 on here, and maybe it's on the next slide. I would just say, if you're advertising a 7-year hold, put all 7 years on there. But I do think that,
Brian, I had it marked. I was ready.
Boom. Yep. There you go. There you go.
And I think Heshel and I talked on this offline. This is about consistency. And I'm pretty sure what happened was at one point when you're doing the deal, and this happens a lot here, these deals, just so you know, as a passive, these deals go through so many iterations of business plan, of hold periods, of et cetera. It's very easy to lose track. And I think maybe at one point you might have had this intended to be a 7-year hold. And then for whatever reason, you decided, this is better as a 5-year hold. And so the pro forma model got changed to a 5-year, but nobody scrubbed the presentation and pulled that out. And so that's another thing. So whenever we do our presentations, you'll notice all of the metrics are in a table form. And that's because we're copying that table and pasting it so it's copying from our model and paste it into the pro forma. Reason being is so that mistakes like this don't happen. So whenever I say it's a 7 or 5-year hold, it's because it's in a table that came from the pro forma, and that whenever I change the pro forma hold period, it automatically updates the table. So that's one way to avoid those inconsistencies, is to avoid manually typing in as much data as you can into the PowerPoint.
So it's actually linked to your pro forma. So
it's either linked or it's a copy paste from that table, and it's very obvious the table is out of date.
Right.
But yeah.
I'll say on our first syndication, we had we probably had 8 or 10 different iterations of the pitch deck that we had actually distributed, and we realized that on our second deal that was a mistake. It was every time we had major updates, we would update our pitch deck and start using that one. But for us, what we do is at one point we just say, this is the finalized version of our pitch deck. This is what we're sending out, and from here on out, it's not changing. So. And so far that's worked for us, but it just means we're sometimes we send it out a little later than sometimes we want to.
Yeah, no, I think we've all had those struggles. I've had it as well. And one of the nuances that we do, Brian, is so we also draw a line in the sand as well. You get to a point where you got to draw a line in the sand and say, these are the numbers, and these are the numbers I'm going to present the deal as. And you can continue to refine them. You're still going through due diligence. Things are continuing to evolve. Your finances are continuing to change. Your loan terms may change up to right before closing. And then the day we close, we send out a final pro forma. We say, this is our final, this is what we are projecting we're actually going to do now that all the dust is settled, or at least up to the closing date. And then we actually sign off. So everybody signs off on our pro forma, and we give that out to the investors so they know that here's our commitment to you, the investor. And here's our final numbers, and then we'll let the chips fall where they may for the next 5 years. So all great ways to do it. So anyway, back to your return slide here. I noticed prior to this return slide, though, there was one very important slide that was missing. So we talked about a trailing 12 for how the property is currently doing, which would typically just be like a single column. But there was no slide anywhere where you're saying, here's our NOI, our GPR down to the net cash flow for the next, 5 years now on the deal. You just jump straight to investor returns, but you don't. So there's a line here that says cash flow distributions, but there's no way to show where did they come from? How did we get to this number? And so yeah. And I don't know if that was, I didn't see it in the backup anywhere, but anyway, that was just, I think that is, that at least for our students, it's the most important slide. I teach them to look for that slide first, just dig through the package, pull out that slide, and then leave the rest alone. And from there, you can kind of start doing your analysis. But if you don't even include that slide, then they can't determine, well, what was the rent growth? What was the vacancy? Do I feel comfortable with that? Where's the tax growth? You just give them straight to the answer. And I think that for some investors, well, for a lot, really, they want to know, hey, how'd you they are doing some analysis. So anyway,
I would echo that. When I look at deals as a passive investor, I mean, I'm going to look at the overview slide. I'm going to look at the markets and everything else. But there's only like 2 or 3 things I'm looking for on the number slide. Number one, what are the rent projections and are they realistic? Number 2, what is the exit price? Okay, I'm always looking at that exit price, and I want to know how they come up with the exit price as well, because those are the things that are going to drive more than anything else. And then I'll also look at the expense ratios just to see what they're doing with the expenses. But those are the 3 things that I look at personally. I want to know, are the rent bumps realistic? Is the sale price realistic? Those are the 2 biggest things. And then check out the operating expenses. So I echo what Joseph says, those do need to be in there.
Very good. Yeah. And so typically some of the other things that you would see on that executive summary, coming back to that slide, is you would see the cap rate that you're buying at, you would see the cap rate that you're exiting at.
Right.
I think those are very important, or also called the reversion cap rate. I hate that word. It's called the exit cap. Let's not use fancy words here. From Louisiana, we try to keep it simple. So now the next slide, we're on slide 9. We're talking about rent comps, rent and sales comps. These are all very important. And again, I think you'll notice it's a little bit different for smaller units, because I think you are more bootstrapping this. And if I'm not mistaken, you're looking at, these are houses on here. So you've got a mixture of apartments and house rents, which is perfectly normal. My first deal was a 26 unit deal. The entire basis of a 30,000 per door renovation we did was all based on surrounding rent comps for houses in the area. So I think just providing some data though is great. So I think you've done a good job. You can tell you've done this by hand. And for me, that carries a lot of weight for me, because if I know that it means it's a lot for you to go out by hand and get this data versus for somebody just to pull a report on Yardi or wherever and get those rent comps, means that you did a lot of research here. That's what that tells me. You've done a lot of research. You feel very comfortable with these numbers. And so I think as a passive, just keep that in mind, that you can kind of tell if somebody had to really work to get these numbers, that they've done a lot of research, that it's not just them running a report online and selectively choosing some comps.
Yeah, and for those listening to this, he's got a couple of Google Map chips on there where he has individually put each pin in place where all the properties are, and then underneath it has a table for the rents. And I think same thing. I was thinking the exact same thing when you brought it up. The level of detail you put in, you basically customized your own CoStar report is what you did.
Yeah. So I feel incredibly comfortable on the rent comps here, just because I'm like, wow, this guy has done his research, and yeah, looks good to me. So great job there. As you get into bigger and bigger deals, though, you're going to start, pulling out. This won't be as applicable. So I think it's also a story and what's possible, what you can get away with and do for when you're buying smaller properties, especially when you're bootstrapping, because those softwares that we have, it's a couple $1,000s a year that we're spending, several $100s a month just to keep those subscriptions going. So they're not free. And especially when you're starting out, you're getting your first couple of units, you really got to keep things pretty skinny. And so I think this is absolutely a great way. But as you start graduating into much bigger and bigger deals, you're going to want to start getting in those access to those softwares. So now we're going to the market insight slide. Lots of color, man. My ink cartridge is struggling right now.
Send me the invoice for a new ink cartridge.
And then so now we're on page 12. So here's where you're just kind of giving some highlights. For me personally, I've never. I think these are important slides, but I've never really dug into them too much. But that's also because I've been in my same market for the most of all of my career, all 10 years. I think if somebody were passively investing and didn't know Columbus, sure, these are all important. I think you've done a great job of presenting it as such, as from the perspective of an investor who is not familiar with your market and doesn't know all the great things around it. So I think it's important to have these. Most of my investors tend to come from my market. So I don't do as great of a job as you have done here showing all those things. So kudos to you.
I'm actually noticing now as I'm looking at this, that these are for the Cincinnati market. So it must have been one from a previous deal and it just wasn't updated yet on this package.
Well, again, I don't know your markets. I wouldn't have noticed that they weren't for exactly the correct thing, but
Yeah.
great job pointing that out. So in the future, make sure you're pulling market comp for the right market.
I wouldn't have caught that either, but I've driven through Ohio a couple of times. Honestly, I couldn't tell you how far Cincinnati and Columbus are from each other. So I think this worked, pulled the wool over my eyes. I know that's not what you were trying to do, but good point.
Yeah. And then, so now we're showing, so here's the actual properties themselves. So you saved all the photos, and these are actually some pretty nice photos. Page 13 and page 14 of a 16-page package. You've got the photos of the properties. I would have liked to see these photos up front. A lot of times what we'll do is the cover page will be the photos. So like the first thing you see is you would have seen, I think this property on page 14 on Sullivan Avenue is a nice looking property. And if you put some nice little effects over the top of it, I would have made the cover slide a picture of this, or really these two together. You can kind of mirror them together. But people are visual, especially investors. You're gonna have visual investors and you're gonna have numbers investors. You got to cater to both. And by putting these pictures at the very end of the package, you really starved that investor who's looking for those photos to the very end, and you just hope they made it to that last page. So that's my comment there, is incorporate those photos much earlier on. I like to do it on the cover page, but you can do it, whereas make sure they're towards the front. Yeah.
And I'll add, this stuff is the stuff that's worth printing out, right, Joseph?
Yeah, this stuff is worth printing out.
This is worth the ink.
This is worth the ink. Absolutely. And then we've got our contact us page. So great job putting your contact details there. I think that's a slide that a lot of people forget. Honestly, I forget as well sometimes, is to do that. And here's a pro tip that we're doing now. We're actually putting a QR code on our last slide. And so they can just put their phone over it, or even when on a presentation, if it's printed or if it's on a computer, they can hover over it and the QR will pop up. It'll be a link tree, and they can then subscribe to the investment. They can do whatever, capture their email, because you never know where these packages end up, right? You put it out there and it goes wherever it goes. And sure, it's great that you've listed all this, but now what does somebody have to do? If one of my friends just sent me this presentation, and I'm being lazy here, right? I would think, oh man, I gotta go type in Heshel at benchmark prop stock. It's not that big of a deal, but we know as much as you can make this one step less for investors, you should do it. And also, you haven't captured anything, right? They've got your info, but you don't have their info. And so I would recommend putting out, a QR code. We actually use a flow code, which is a really cool QR code. But anyway, you could put that on there, including, so look, you've got all this space on the right side. So you can put all this and your QR code, two birds with one stone.
Yeah. Now, one thing that I would say on that last one, you have your capital call date, but it kind of gets lost, if that makes sense. So you have your contact us. Most people, me personally, I get to the contact us slide and, I'm like, okay, presentation's over. Okay. So I do think the timing of the deal is important as well. Here's when the offering, the private placement memorandum is coming out. Here's when funding window opens. Here's when the funding window closes. Here's when the deal closes. We like to make sure the timeline is clear. And I think putting that on the very last slide could get lost, just because, if anyone else is anything like me, as soon as you see that contact us slide, you're like, okay, presentation's over. And I turn my mind off.
Yeah, I've seen some really great presentations, and you probably do the same, Brian, where you've got that timeline list on the bottom, like a bar, you put the dates. I mean, people get really creative with the graphics, and I think it's great. I mean, we're starting to do it as well. And, but I think that's absolutely an executive summary type graphic, because that's one of the main keys that somebody needs to see. So when you
Yep.
back to when you're doing that executive summary, just imagine that that's the only slide. A lot of people call it a one pager as well. So if that was the one page that they got, you need to make sure you've got all that stuff on there.
So Heshel, how's this deal come out so far? I mean, you closed on this 2 or 3 months ago, right?
Yeah, it's coming out really nicely. Thank God it's coming out really nicely. We're still in that transition period, implementing a big part of our business plan of doing, the major capital improvements. By the time we got to closing, there were a couple of vacant units. We had to turn those and get those filled, which turned out really well. So we're right in the thick of finishing out our business plan, and we hope that in a couple months we'll be able to say that big first bulk of it will be complete, and then be off to the races from there.
Awesome.
Well, a couple of other quick comments, Heshel. I was just flipping through it one more time, the presentation. So back to our earlier discussion about transparency and showing fees. So back on that slide, which we noted was missing, where you're showing the projections from your NOI, net cash flow, et cetera. We take that time to go ahead and we show the investor returns for whichever class they're in, and we also show the asset management fees and the promote that we'll be receiving for all those years. So that way it's all on one page, and they can take away with it and do what they will with it, and do their analysis. Another thing that was not mentioned was anything about your debt in the slides. We don't know what kind of debt it's going to be getting. We don't know any of the terms for it. We don't know any of the terms of the refinance. So those are all things that I know you have those assumptions somewhere because you came up with that analysis. So just make sure that is shown so that investors can, have, at least have that information available to them. Also, because whenever you go to exit these deals, they're always going to pull up that presentation and they're going to say, hey, well, what were the assumptions? What did you tell me? And you got to be able to show that.
All right. Awesome. Well, hey, thank you so much. Well, first of all, Heshel, congratulations for closing this one, and congratulations for the one you have under contract that I'm sure you guys will close on shortly. And Joseph, definitely thank you for walking us through this. I made a bunch of notes, and I think this is extremely useful information. So thank you to the two of you for coming on and walking through this. So one question that I have for each of you, just to close up, how can listeners and viewers learn more about you guys? Joseph, you go first.
So they can check us out at TriArcRep.com. And you can also find me on LinkedIn. I'm pretty active there, as you know, Brian.
Yep.
Joseph Bramante on LinkedIn. And if they're interested in joining Become One Investors, again, go to our website, TriArcRep.com. There's a little button there that says Become an Investor. And they'll learn all about us.
Yep, absolutely. And Heshel, same question for you.
Yeah, LinkedIn. I think that's where all three of us met originally.
True.
So this is the power of LinkedIn is right here. Try to stay over there and can find me there. I've actually also been toying around and getting a bit more active on Twitter as well. So
all right,
you can look for my name over there.
But hey, I want to show one more. I want to show off that flow code because we just got it made. So I want to show you guys.
All right, let's see it. I actually Googled it while you were doing it. Oh, and it's branded too.
It's a branded QR code.
That
and so if
is
you hover
amazing.
over it, it'll pull up our flow tree. It's got my photo, my bio, and it's got all my contact info right there. So they can hit the button and it'll call me right away or text me or whatever. And I can edit it constantly in the background while the QR code stays the same. So yeah, it's not some ugly QR code. It's a very nice, pretty looking thing. That's been custom branded for us. So anyway, did it work for you?
Yeah, it's loading right now. Good picture of you up top, Joseph Bramante. Yeah, and it's got all of your contact information. I like it. We're gonna be looking at that here soon. So I think it's a great idea. But anyway, thank you so much for coming on the show today. Appreciate your time. And then for those listening or watching, we will put links to everything that was mentioned here. There's the social media profiles and whatnot in the show notes for you guys to just reach down and tap and learn more about. So thank you very much. And that's a wrap.